You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well this Wednesday. Today's kind of like a special day for me in a sense, like not the day itself, but the fact that I just realized how far my pension plan account went over the past almost 8 years. So 8 years ago, I was coming back from an RV trip. So in 2016, I took a sabbatical year. I traveled in a small RV with my wife and 3 kids. We drove all the way down to Costa Rica, and then we went back. We came back on July 1st of 2017. At that time, I decided when I came back to Quebec, I decided that I would quit my job and that I would start working full-time on Dividend Stocks Rock, which has been one of the best investment decision in my life, and financial decision, of course, in my life. One thing that happened then is since I quit my job at the bank, I received the value of my pension account. So I had the two options. Either I kept the pension with National Bank and I would receive a very small amount per month at retirement, or I could have received a big check of $108,760 and 2 cents. So let's say $109,000. That I received that I had to put in a locked-in RSP, so LIRA accounts. I could not withdraw that money. I cannot add capital to it. It is set in stone in that account until I retire. I decided, of course, to take that money and start investing. So I received that check around September of that year in 2017 and started investing. After 2 months, I was 75% invested, and by December, I was fully invested. The only reason I took so long, which was a big 3 months, right? The only reason why I took so long is because I was working a lot more on Dividend Stocks Rock than I was working on my portfolio, and that was just not part of my priority. So I had big projects and I needed to just make money to pay my mortgage and other payments right away. So investing was not the priority. So that's why it took me 3 months. If not, I would have invested everything within a few days in September, but I still wanted to do my due diligence. I still wanted to make sure that I invest in the right companies and so on, and my portfolio would make sense. So what struck me last week was that my Canadian portfolio is now worth $109,000. So when I receive my pension account, I split that amount in two. So half of it went into the US market and the other half went into the Canadian market. And as I often say, it's best if you want to invest in the US market that you keep your dollars in USD. So I have a USD account for this locked-in RSP and a Canadian account. And the Canadian account is now worth what I received back in 2017. It hasn't been a perfect returns between both because I sometimes swing money from one side to another just to make some trades. So overall, I'm trying to maintain an half and half, but right now my US portfolio is a lot bigger. And long story short, while my Canadian account is the amount of the pension account, the total value of this pension account is now $270,000, which is kind of crazy. And I'm not telling you that to brag or to tell you how great my returns were back then, but rather to try to inspire you of staying invested and sticking to your strategy, even if you're going to make mistakes. Because I made plenty of mistakes in that account, in that account includes my speculative play on VF Corporation that did not turn well, my investment in Sylogist, my investment in Algonquin. A few years before, I invested in Andrew Peller and Lassonde Industries, lost money on both. So that account included a lot of mistakes, but it also includes a lot of great story, like great winners such as Microsoft, such as Alimentation Couche-Tard, such as Brookfield, Visa, BlackRock, National Bank, of course, Apple, and as of late, I have some other interesting winners as well, such as Stella Jones and LeMaitre Vascular that are up like 30 and 56%, and I didn't like bought them like that long ago. So overall, just to show you how if you stick to the same strategy over and over again, and that strategy makes sense, yes, you're going to have some bad moves, but you are going to have a solid batting average, and overall the portfolio will just go up. That works also if you invest in ETFs. That will work super easily as well. And the key again is just to stay invested. What is great now is I can do some simple math where I have $270,000 in that account today. And if I just use the simple rule of 72 and hoping to generate 7% return, so doubling my money every 10 years. So when I'll be 53, that account will be worth a little bit more than $500,000. And when I'll be 63, well, that account will be above $1 million. And of course, I have like my RSPs and I have like DSRs and I have like other investment rolling. But just that account alone, just the fact that I am sticking to the same strategy, if I average 7% return, which is 100% in stocks, so it kind of makes sense to aim for that type of returns. I know that I'll have more than $1 million before I retire. Well, I mean, between you and me, I don't count on retiring in the 60s. I think I'm going to just work until my faculties doesn't enable me to work, because I see work as a hobby, as a passion, as a game, actually. So I'm just enjoying what I do. So that's a bit different. But yeah, so all of that to tell you that it is very easy to reach those numbers and possible as long as you just focus on your strategy. So let's take a moment before I let you go and talk about my biggest holdings in this account. So biggest holding is Microsoft. Right now at 10% of that account, but I do not hold any other Microsoft shares outside of it. So it's not set to my rule to be sold, even though it's 10% weight in this portfolio. So when I set the rule of 10%, it's always about all my portfolios together. So it's 10% of all my investable assets, not just one. So Microsoft, I will continue to write it up. This one, obviously, I bought it at $75 back in 2017 when it was highly overvalued by most analysts, and you know the rest of the story. So never trust and never like focus on price and valuation when to make an investment decision. Second on the list, Alimentation Couche-Tard. Still, this one was also a pretty solid pick. I bought it in 2017. I bought it again. I doubled down on my investment when the stock dipped after failing to buy Carrefour. So that was the story behind this one. So it's at 9% of my portfolio. Down to 8% now, Brookfield Corporation. Well, this one was also an interesting one. I bought it not too long ago, maybe like a year or two ago. I can't remember. So it has had a pretty solid ride not too long ago. So that explains why it's now at 8% of my portfolio. Great asset manager. They are able to benefit from so many different business segments and investment opportunities. That's what I really like about them. And the fact that they focus on alternative assets, which like narrowed down the number of asset managers that can do that. And it's one of the largest one in that field. So definitely a pretty solid player here. Visa at 6.65. I mean, a toll booth, like just generating money all the time. As long as you use credit cards, they make fees on that, and they do not carry debts. If you want to know more about that, you can go on Dividend Guy on my YouTube channel. I just did a comparison between Visa and MasterCard. You're going to really love it. So on the Dividend Guy YouTube channel, you'll see it. It's fairly recent. BlackRock at 6%, another asset manager. That one I have been holding it since 2017. Home Depot we all know it, right? Another great one that I was able to buy while the stock price was not too high. So this one is like just steady heady at this point, just waiting for the next economic boom to see some great profit going out of it. Stella Jones at 5%. You know my love for Stella Jones. I've been documenting it, talking about it a lot this year, but I bought it at the beginning of the year, if I remember correctly. And National Bank at 5%. Not going to tell you more about this one. It's in all my portfolio. So again, it's there. And two others that are close to 5%. So Texas Instrument at 5% and Automatic Data Processing at almost 5%. As you can see, a lot of my US stocks are being part of the top weighted stocks in this portfolio. Not so much for the Canadian one. It has been a rough patch for many Canadian stocks. So I do have some large position like with Alimentation Couche-Tard, Stella Jones, Brookfield, and National Bank. But of course, right now, the money is being made on the US side. It's not going to be always this way, but it's just to understand what's going on right now and just making sounds of it. But in the end, it's the overall portfolio that counts. All right, Moose, I definitely extended this one, so I hope that you have enjoyed. Again, forward it to one of your friends, one of your colleagues, your family, if you want to inspire someone to stay invested for the long run. Speaking of which, tomorrow I'm going to talk about a pretty cool stock on the Rockstar list, so stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.